Are you ready to make every bit of your money work for you? Imagine this. You've saved up enough money to buy your dream home outright, no mortgage. But is paying cash really the smartest move? What if I told you that taking out a mortgage could actually make you more wealthy in the long run, even with where rates are today? Prime rate over 8%, mortgage rates around 7%, and credit cards over 20%. We have this tendency to be tunnel visioned into chasing the lowest rate instead of making every dollar you have work for you. Look, I get it. We all want the lowest rate on everything, but if you're solely focused on the rate, you may be missing out on the potential opportunities to use leverage to grow your net worth. In today's video, we're looking into the math behind a 7% mortgage on a $400,000 home over a 30-year versus investing that cash in the stock market for potentially huge returns. We'll explore how a mortgage might not just give you the freedom to invest, but also the flexibility to enjoy life now without sacrificing future wealth. Stay with me. What you're going to discover today could change your financial future forever. Hey everyone, welcome back to my channel. My name's Darren Hunter, and today we're tackling a big question. Should you buy a house with cash or take out a mortgage? If you even have the opportunity to have saved enough to buy a house with cash, it is a crucial decision that can have a massive impact on your financial future. We're going to break down the numbers, look at the pros and look at the cons, and by the end of this video, you'll know which option might be the best for you. So let's go ahead and dive in right away. All right, let's set the stage with some real numbers so you can truly understand the impact of buying a home with cash versus taking out a mortgage. Imagine you're about to purchase a $400,000 home. If you decide to take out a mortgage, you're likely are going to opt for a 30-year fixed rate loan. Currently, the average interest rate for a mortgage is around 7%. Now, trust me, I know 7% might sound high, but bear with me because this is where things get interesting, and this is where we need to really change our mindset on how we think of money and how we think of leverage. First of all, let's break down what this mortgage would look like over the next 30 years. With a 7% interest rate, your monthly payment would be approximately $2,661. That's just the principal and interest. This is not including your property taxes, not including your insurance, nor is it taking into consideration any sort of maintenance costs. Over the course of 30 years, you'll make a total of 360 payments. That's 30 years times 12 payments, each one being $2,661. When you add all those payments together, you will end up with a staggering number of $958,000 that you'll pay over the life of the loan. That's right, you're paying almost $1 million for a $400,000 home. Now, out of that $958,000, $400,000 is the principal. It's the amount you initially borrowed. The remaining $558,000 is interest, the cost of borrowing the money. So over 30 years, you're paying $558,000 just in interest. I know it's a huge number and it might make you think twice about taking out a mortgage, but hold on. And again, this is where we need to change our thinking. There's another side of the coin. Let's say instead of paying for the house outright with $400,000, you decide to take out a mortgage and invest that $400,000 into the stock market. Historically, the stock market has returned an average of around 6 to 7% per year, and that's probably on the conservative side. It is. Now, this isn't a guarantee, of course. The market goes up, the market goes down, but over the long run, it averages around that 6 to 7%. For the sake of this discussion, we will use 6% to stay on the conservative side. If you invest $400,000 at 6% annual return over 30 years, thanks to the magic of compounding interest, your investment could grow to approximately $2.3 million. Yes, $2.3 million. So while you're paying $558,000 in interest on your mortgage, your investment is growing exponentially. All right, let's do a quick comparison. You're paying $558,000 in interest, but your investment grows to $2.3 million. Subtract out the interest paid from your investment gains, and you're left with around $1.7 million in profit. That's a significant difference and shows how leveraging a mortgage can potentially help you build more wealth over time. Oh, and by the way, at this point, you've paid off your mortgage and your home has been appreciating around 2 to 3% over the last 30 years. For those not familiar with compounding interest, let's break it down and show how it works. It means you earn interest not just on your initial investment, but also on the interest that accumulates over time. So if you invest $400,000 at an annual rate of 6%, here's what happens over 30 years. Year one, at the end of the first year, your investment grows by 6%. So you have $424,000. Year two, in the second year, you earn 6% on that $424,000, not just the initial $400,000. So you have about $449,440 by the end of the second year. Year three and beyond, this process continues with your investments growing each year. By the end of 30 years, your initial $400,000 investment could grow to approximately $2.3 million. This means that even after accounting for the interest paid on the mortgage, you've significantly increased your wealth. But why does this work? I'm going to give you a few reasons. First of all, leveraging low-cost debt. By taking on a mortgage, you're using the bank's money to invest in a potentially higher returning asset, the stock market. This is known as leveraging, and it allows you to amplify your investment returns. Compounding over time. The longer your money stays invested, the more it can grow due to compounding interest. This is why starting early and staying invested is crucial. Diversification. By keeping your cash invested, you're not putting all your eggs into one basket, into only real estate. You have the potential to earn returns from both real estate appreciation and stock market gains. Of course, investing in the stock market comes with risks. It's not a sure thing without a shadow of a doubt, but over time it is proven to be beneficial. Market fluctuations can affect your returns, and there's no guarantee that the market will always perform well. However, historically, the market has trended upwards over the long term. Let's illustrate this with a simple example. If you invest that $400,000 at the 6% annual return we've talked about, your money could look like this over these particular years. 10 years, approximately $716,000. That's still greater than the interest paid. 20 years, approximately $1.28 million, significantly higher than the interest paid. 30 years, $2.3 million. This is a great opportunity to use leverage to grow your wealth. Even considering market volatility, these figures show the potential of long-term investment growth. By leveraging your mortgage, you're giving your money the opportunity to grow substantially over time. Now that we've covered the investment potential, let's move on to the pros and the cons of each approach beyond just the numbers. All right, we understand how investing the money you would have used to buy the house can create substantial wealth. Let's explore the particular pros and the cons of paying cash versus taking out a mortgage. This will help you make a more informed decision based on more than just math. Paying cash has its own perks too. Let's break down a few of the pros. Simplicity. No mortgage process, no paperwork, just a straightforward purchase buying cash. You wire the money, you walk out with keys. Peace of mind. There's no monthly payments hanging over your head. There's no opportunity for your home to be foreclosed on. There's a caveat to that, but for the most part, there's no foreclosure opportunity. Competitive edge. Cash buyers are often more attractive to sellers, especially in this competitive market where 30% of all homes are going above asking price. Saving on interest. You save that $558,440 in interest payments that we've been talking about prior. Now let's talk about the cons. Opportunity costs. If you pay cash, you miss out on potential investment gains that we just broke down. Liquidity issues. Your cash is tied up in the home, making it harder to access in case of emergency. If there's a family emergency and you need cash, your house is not liquid. Less flexibility. It's harder to leverage other financial opportunities without liquid cash. Typically, if a financial opportunity comes around, you're going to need some sort of cash to get into that investment. On the flip side, let's look at the pros of taking out a mortgage. Investment growth. Potentially turning that $400,000 into the $2.3 million that we broke down. Liquidity, keeping your cash available for emergencies and other investments that we just talked about. Family emergencies, other opportunities. You're typically going to need some sort of cash to get into a financial opportunity. Tax benefits. Mortgage interest deductions can reduce your taxable income. Listen, that used to be a much more significant pro. Nowadays, with the standard deduction, it doesn't mean nearly as much as it used to, but for some, it can be beneficial. Leverage. You can use the bank's money to grow your wealth. You've heard many people talk about use other people's money. Well, here's a perfect example. Use the bank's money. Lastly, the cons of taking out a mortgage. Interest payments. Now you're paying a significant amount of interest over that 30-year period. In our example, we're almost $600,000 in interest. Debt stress, the psychological burden of owing a large sum. I've felt that in the past. That is a real thing. Owing a bunch of money is never a great thing until you become accustomed to it and understand how it works. Market risks. Investments in the stock market come with risks and are not guaranteed. There's no doubt about that. Over time, it has shown to trend in a 6 to 7% clip. However, nothing is guaranteed. So, which option is best for you? It all depends on your financial situation, your risk tolerance, and your long-term goals. If you value simplicity and peace of mind, paying cash may be the way to go. But if you're looking to maximize your wealth, taking a mortgage and investing could be the smarter move. In the end, the decision to buy a house in cash or get a mortgage is a very personal one. I hope that this breakdown has given you some sort of clarity and given you the information to help you make a decision. What do you think? Which option resonates with you? Let us know in the comments below. Don't forget to like, subscribe, and share this video with anyone who's on the fence about this big decision. Thanks for watching. We'll see you next time. And that was another guaranteed video. Take care.